Friday, August 16th, 2:48 p.m. New York time. Welcome to Winning Wall Street's Money. I'm going to discuss US dollar index, the yields, and the bonds. I want to get access to the video the same day I post it. I have a link below. It's my Patreon page. You get access the same day, post them, and a lot more great content. This correlation between the US dollar and yields. First, look at the history of the US dollar index, 20-year history. US dollar, you could trade it. You could trade it in the futures market, the equity market, the options market. A lot of opportunities. The 20 years, here's the low. And here's the high. Big difference, huge trading range. Now, for this year, here's the high, here's the low. I'll zoom in. Here's the high of this year. Here's the low of this year. Currently for the month, because we're already halfway through the month, making a lower high and lower low. It's trending down. Very likely to test the low of this year. If it breaks below that, break below the low of last year. Well, if you notice the high of last year, the low of last year, we're still inside that range. Lower highs. So again, higher probability, the trend is down. More likely, more the wiser, should be trading bearish bias. High of 2022, high of 2023, high of 2024. I'll update this because I think I made a typo. Yes, I did. Here we go. Now we're going to look at, well, first I want to mention here too, if you're not familiar with the US dollar index, it's comprised of several currencies. The top three, the euro, Japanese yen, the British pound. The euro making up almost 60% of the US dollar index. Now we'll look at yields. US Central Bank, aka the Federal Reserve, controls short-term interest rates. US Treasury Department auctions off fixed income products, different durations, to raise capital to borrow against. There's different durations. When you hear bonds, they're the longer term fixed income products. And your shorter term ones, you hear notes. And then shorter term ones than that too. It's other names. So here we're looking at, again, 20-year history, 30-year yield. Yields trade inverse from bonds, notes. Yep. See, and when the interest rates are going lower, one expect the yields go lower. Interest rates go lower, yields go lower. Yields go lower, interest rates go lower. Got it? Bonds and notes go up. So here, looking at the 30-year, here's the high on the left, 2007. Here's the low, 2020. Here's the high of last year. Here's the low of last year. We're still inside the range of last year. And we're trending down. Yep, very close to the lows of this year. So there is a correlation. You see the 30-year doing the same thing as the US dollar. You often see a correlation again. Lower yields, lower interest rates, lower US dollar. Now we're looking at the 10-year yield. Look what happened. Again, shorter duration. One would expect it to move faster than the 30-year. Well, look what happened. We broke the low, making a new low for this year. Still inside the range. Here's the high of last year. Here's the low of last year. Still inside the range of last year. Made a new low for the year. So the bigger financial instrument, that 30-year, likely would do that, but on a slower pace. We are on the 5-year yield, even lower duration than the 30 and the 10. And it also broke the low of this year, making a new low this year. Still inside the range of last year. There's a low of last year. There's a high of last year. Now we're looking at the 2-year yield. Big difference. Look at that huge breakdown. Took out the low of this year. Again, still inside the range. Here's a high of last year. Here's the low of last year. So one would expect sooner, much sooner than later, the 30-year will break the low of this year. But seeing here, we identified the 10, the 5, the 2. They all have in common this month, they broke the low of this year, making new lows for the year. Very nice. Again, the dollar, go back here, you can see again the dollar. Very close to doing that too, testing the low of this year. Well, let me show you the correlation. Compare the 10-year, I'm going to show with first the dollar. So looking at 20 years of history, each grid on the left is the US dollar, the left is the 10-year, the left is US dollar index, and the right is the 10-year yield, each 20-year chart. Here's the high of the US dollar back there. And this made a high too, but not as high. So zoom in, looking at the monthly. Both still inside the range of last year. And again, one would expect sooner than later, the dollar is going to break down. So why would you not be trading bearish the US dollar? Why would you not be trading bearish the yields? They are physical assets. And of course, the ones that are paper that you could trade. Let me show you something else as well. Multiple time frames, 10-year yield. 3 grids, the far right, monthly, the middle, the weekly, and the left, the daily. Trending down on the monthly, weekly. Look what happened. Last week, that green candle went up, tested that midpoint right there, and filled to close above it, showing more bearish bias, which made that new low, and current week inside candle. Daily, again, we still got about an hour until the market closes. Daily, we have that inside candle. So if it continues going up, we try to test this swing high, more than likely it's going to fill. Let me label that too. So if you want to be able to look straight bearish at the higher price level, well, you look up near this range. If it gets up there, it may not happen. That's the 10-year yield. Let's look at the dollar. If you wanted to trade bearish, same thing, 3 grids, far right monthly, the middle weekly, and the left daily. Look at the weekly, inside candle for the month. Testing that trend line. Inside candle, well, potential reversal on the bottom. Potential reversal on the bottom. Potential retest here, midpoint. Looking at the daily, big red candle, almost solid body, very bearish. Yep. Then we got these big wicks down here, buyers. So depending on where this close, might go down there, test that first, and then maybe go back up higher, do some tests up here for opportunities to look to enter bearish. And we'll take it to the faster time frame, intraday. We'll be looking at the 3 grids, far right weekly, middle daily, and the left 4-hour. Here we go. The last 4-hour candle, so tiny. Big rejection on that 4-hour candle. So that green one, that was the 9-1. Big rejection on the yields. Opportunities. Might be getting a retest down here sooner, first going back up there. And we'll finish this off by looking at the US dollar. Intraday, 3 grids, weekly, the middle daily, and the left chart 4-hour. Huge move down. Big difference than the yields. Yep. And very bearish dollar. See if I have a comparative show to show comparison of the yields in the, there we go. So left it's the dollar, right it's the yields each 4 hours. A lot of price action. US dollar, we're looking at 10 days, 4 hours, look at the dollar, huge sell-off. And yields still holding right there. Thank you for watching. That's it for the video.